You bought the stock. Earnings came out. Record profits. You smiled and checked the price. It was dropping. "What's going on?" you said. Most people think about the stock market like this. If the company is doing well, the stock goes up. That logic is half true. And half-truths can be more dangerous than being completely wrong. Because with that framework, you can lose money on the right news. And in that moment, one thought hits you. Am I missing something? Here's the core idea. The market doesn't price the past. It prices the future. When you buy a stock, you're buying a claim on future earnings. Not what the company made today, but what it's expected to make over the coming years, valued in today's terms. Once that clicks, the record profits but stock dropped paradox starts to make sense. There are two dials that move stock prices. First, expectation surprise. Was the earnings report better or worse than what the market expected? Second, the discount rate. How much the market discounts future earnings to bring them back to today's value. That discount rate is driven mainly by interest rates and risk perception. Very roughly, the formula looks like this. Price equals expected future earnings divided by the discount rate. The bigger the numerator, the higher the price. The bigger the denominator, the lower the price. Let's start with expectation surprise. The market doesn't read news in isolation. It compares news to expectations. This is where most people get tripped up. The market can look at good news and say, not good enough. For months, everyone might have been saying, this company is going to post record earnings. Investors position themselves for that outcome. That expectation gets baked into the price. Then the company reports record profits. The market asks one question: is this better than what we expected? If the answer is no, if it's just in line or slightly below expectations, there's no positive surprise, and the stock can drop. The headline says record profits, but relative to expectations, it may actually be a disappointment. Markets move on deviations from expectations, not on headlines. There's another layer. Not all earnings are created equal. Before asking, is there a profit? The market asks, will this profit last? There are different types of earnings. Real, growing, recurring earnings. The market loves those. One-time earnings, a tax benefit, an asset sale, those don't usually deserve a high valuation. And then there are earnings that look strong today but signal weakness ahead. Maybe prices were raised and profits jumped, but customers start leaving. Maybe forward guidance is lowered slightly. Even if today looks good, if tomorrow weakens, the stock can react sharply. The market buys tomorrow, not today. Now let's look at the second dial, the discount rate. The company might be exactly the same company, but if the environment shifts, the price can shift too. When the market brings future earnings back to present value, it applies a discount. That discount is driven by interest rates and risk perception. Start with interest rates. If you can earn a high, risk-free return in government bonds, why take the additional risk of holding a stock? When rates rise, bonds become more attractive. Money can move out of stocks. Prices can fall. The company's earnings haven't changed, but the price of money has. Now consider risk perception. When uncertainty rises, investors demand a higher return to compensate for that risk. War, elections, sector crises, management changes, these may not immediately change earnings, but they can increase the required return. And when the discount rate rises, the present value of future earnings shrinks. Same earnings, higher discount rate, lower price. You saw this clearly in 2022. Many major tech companies posted record earnings. At the same time, their stock prices fell sharply. Interest rates rose quickly. Risk perception increased. Growth expectations were revised downward. Both dials moved in the wrong direction at once. So next time you see an earnings headline, pause and ask 3 questions. 1. Was this already priced in, or is it a genuine surprise? 2. Is this earnings growth sustainable, or is it a one-time effect? 3. Has something shifted on the interest rate or risk side? Someone who asks these 3 questions is reading the market very differently from someone who just reads the headline. The market doesn't price news. It prices expectations, risk, and alternatives. Most people are still reading the headline. You're now reading the model behind it.